Australian dollar had another volatile week, falling to new lows since March 2009, just above 68 cents, and later in the week rebounding above 70 cents. The main driver was global equity markets, with local news flow fairly quiet. In particular, Wall Street's gyrations have joined China in upsetting the Australian dollar. The Aussie dollar is normally positively correlated with global equity sentiment. This makes sense because Australia benefits when global economies are strong, and it weakens during recessions and growth slowdowns. So over the course of 2015, for instance, there was a positive daily correlation between the Australian dollar and the S&P 500 of 0.26. So that's positive, but not especially high. But so far this month, the correlation has been at 70. So the Aussie dollar is unusually closely tied to equity prices at the moment. Obviously, China's economy has been one source of particular concern, and this week we got an update on their growth. The GDP number was pretty close to expectations. It is still decelerating, but it wasn't alarmingly weak. And yet we have had this great volatility in equity markets, which suggests that we should be more worried about the growth outlook. Commodity markets are sending mixed signals, with oil prices very weak, but iron ore holding up reasonably well. So what do we make of all this? Are the global equity markets warning us that growth this year is likely to be significantly worse than previously thought? Or is it a phase of volatility that is likely to settle down in due course? Even central bankers this week have given us mixed views. The European Central Bank sounded quite concerned at its meeting this week. They noted increased risks to global growth from emerging markets and therefore downside risks to their inflation forecasts. However, the Bank of Canada also met this week, and of all central banks, you'd think they'd be particularly worried about the weakness in oil prices. Instead, while describing it as a setback to the Canadian economy, they didn't think that fundamentally much had changed on the outlook for growth in either the US or China, and therefore they kept interest rates steady. Westpac's view is that the global growth outlook probably hasn't changed too much just yet. And we suspect that the RBA has a similar view. Pricing for another RBA rate cut has increased in the past couple of weeks, with about a 15% chance of a February cut now in the market, rising to 100% by August and somewhat higher thereafter. Our view remains that the RBA will remain on hold through this year. However, the RBA rate cut debate will continue in the week ahead, with the focus on Wednesday's CPI. Westpac is looking for inflation to tick up slightly in the quarter to a 1.6% year-over-year headline rate. Obviously, that's still very low, however, so if we got a downside surprise as we saw in New Zealand's fourth quarter CPI, then markets would continue to talk about the potential for a rate cut as early as February. Central bank policy decisions are also in focus overseas in the week ahead, with meetings at the Federal Reserve and also the Bank of Japan. The Fed is very much expected to remain on hold after its rate hike in December. At the December meeting, the Fed had indicated that while it expected to raise rates over the course of 2016, it wasn't likely to do so at consecutive meetings. And obviously since then, we've had the volatility in global markets and also data on the US economy, which indicates a sluggish end to the year. Indeed, later next week, we are likely to get the update on the fourth quarter GDP printing perhaps below a 1% annualized rate. As for the Bank of Japan, there has been increased speculation that they might deliver yet more easing at next week's meeting. This has weakened the yen somewhat after it has been strengthening in concert with weaker equity prices, given the yen's role as a safe haven currency. That could also have implications for the Australian dollar if the Bank of Japan does surprise markets with further easing. So there'll be plenty for the Australian dollar to absorb in the week ahead in terms of local data, global equity and commodity market volatility most likely, and a series of international events. This is likely to see the Aussie dollar fairly choppy again, but within a broad 68 to 71.50 range. We'll speak to you next week.